Hey everybody, it's Jeff back with another weekly installment of the silver and gold market update. And again, I put these videos out to create a historical track record of the premiums, the paper markets, the hedge funds, which are really the most important. They're the ones that I guess everybody says manipulate the gold and silver market. Well, the more you know about their position and how they trade, the more intelligent you could be when it comes to buying precious metals yourself. So we're going to get right into it. First chart I thought the most interesting, of course, is the gold to silver ratio. It got way out of whack, really, when gold hit its peak above $2,000 an ounce. And as you could see, that peaked out above 120 to 1. It was outrageous. And that green line is effectively where we are today, which is about 67 to 1. Silver's made one heck of a comeback, whereas gold has fallen quite a bit from that August high, August of 2020 high, and we're pretty much right in the middle of the range. So I would say, if anything, obviously gold is cheap relative to its recent history. You have to go back to about 2014 to see levels below this for any material amount of time. If you see this ratio get down into the 50s, that's clearly a buy signal for gold from a historical standpoint. And this is how many ounces of gold does one Bitcoin buy you? And you go back to the start of the chart back in Q4 2016, and at best you're getting a 1-for-1 swap. One Bitcoin would get you 1 ounce of gold. And as you can see today, that's 28 ounces of gold that you could buy for a single Bitcoin. It's out of control. And this is really, in my opinion, the crux of the issue of the gold paper market, where for the longest time, really all the way through middle of 2020, gold was the king when it came to this concept of an inflation hedge. And then right around that October of 2020, right before the election, the world changed when it came to Bitcoin, and it got an immediate boost in terms of credibility and just suddenly fear of missing out. Everyone flocked into it. And simply because Bitcoin goes up, now it became the fashionable choice. In my opinion, the best thing that can happen to gold is Bitcoin drops for a sustainable period of time. And everyone suddenly thinks, well, maybe it isn't the inflation hedge. People only feel like it's an inflation hedge right now because it's going up. And trends make people feel overly confident that there is no risk to this market. When if it goes from, as you can see, 5 ounces of gold to 28 in a matter of 5 months, it could also go back down just that fast. The key factors affecting metals really is also the stock market sell-off. And this is interesting, NASDAQ to gold. And this is one thing I've noticed in trade markets for as long as I have. Correlations come and go. And suddenly gold has traded nearly 1-to-1 with the NASDAQ since February 9th when the market peaked. As you can see, since February 9th, NASDAQ to gold was a positive 82% correlation. What does that mean? It means when NASDAQ goes up, so does gold. When NASDAQ goes down, so does gold. And since February 9th, NASDAQ's pretty much done nothing but go lower, as has gold. Even intraday, they tend to trade up and down together, which happens when markets sell off. We remember what happened to gold and silver paper prices in the March 2020 precipitous decline. Gold fell hard, so did silver, because a lot of the funds who own gold and silver also own these high-flying tech stocks. And when the market sells off hard, they sell everything. And that's been a huge culprit of why gold, in my opinion, has been beat down. Not only, of course, money has flocked to Bitcoin instead of gold, but when you get NASDAQ correction like it's been doing, you're going to get a hard pressing lower of gold. And I'll show what the funds have done recently. But just for comparison's sake, January 1st of this year, 2021 to February 8th had a negative correlation. So it just flipped once NASDAQ turned lower. And the last point, the funds have been selling really over the last 3-4 weeks, and there's been very little buying interest. That's really what's hurt gold, in my opinion, is I think the big rush to the physical market happened during that whole silver squeeze time period, and buying, I think, has slowed down a little bit in terms of gold. I think the premiums just got too high, and therefore they're just not as strong. The premiums have stayed high because the supply is limited, but in terms of new fresh buying, I think we're kind of running a little dry. And that's why funds, the selling that they're doing is pushing the market down like it has. Let's dive into the week over week when it comes to silver. And the key columns to look for, of course, is the change in the silver spot price. You could see it's been trending lower the last 3 weeks and took a big nosedive this week. It was down $1.41 week over week, and at the lowest in the 6 weeks I've been tracking this. While at the same time, you go all the way to the far right column, the hedge fund position, and you can see at the very start, on January 29th, the funds were long 43,000 contracts of silver, and they've cut that position by about 30%. They're down to about a long of 30,000. And they sold the heaviest amount this past week, which is why silver was down as hard as it was. The premiums are remaining strong, but honestly, this downtick from APMEX is a bit of an ominous sign, honestly. The thing you don't want to see is premiums drop when the spot silver drops as well, because that kind of reflects the reality that maybe as APMEX is getting reloaded in silver, that they don't have the buyers that they're hoping for. So I get the sense that just maybe there's a bit of a pause happening in the intensity of buying of physical silver. And for note, JM Bullion is a $9 premium. So APMEX is always most expensive. Here's the chart. This trend line is something that all funds watch. And I'll show you a very similar looking one in gold. And when we broke that, that was a very bad sign. You could see that first day we broke it, we fell hard, and we fell hard again just recently. So the chart itself does not look too good. And here's one of the other most important factors affecting gold and silver is the US dollar. And you can see we've actually been on about a week-long uptrend as this trade got too crowded. It's been trending lower since April of 2020. And it became one of the most popular trades. And anytime a trade becomes too popular, regardless of the fundamental justification, obviously the government continues to print more money. The US dollar should be worth less than it is today, but you get these 1 to 4 week aberrations where suddenly it'll trade higher. And that's what's happened with the dollar. So kind of boiling it down, the physical market premiums, I would say, are neutral at best. They're still high. But the fact they've ticked down is a bit concerning. The hedge fund positions, the good thing is they're less long today, which means there's less to sell. But the fact is they're clearly in sell mode. And until something stops the price from going down, they're going to keep selling it. And it's kind of the chicken and egg concept. What comes first? Do they stop selling, or does the price stop going down? And the key is, do we have new buyers come in? And that's a big part of that will be the physical market. Do we see new increased buying? And I just don't know if we do because of these insanely high premiums. The dollar index is short-term bearish, but in my opinion, long-term, I still think the dollar will go lower, which will have an eventual positive impact. And the charts are temporarily bearish as they broke that trend line. Jumping to gold, this is another one, as you can see on the far right column. When we started tracking this, hedge funds were long 96,000 contracts of gold, which is well off the August 2020 high. And now they're long just 46,000. They've sold over half of their position, which has taken spot gold from 1847 down to 1708. So about $140 decline when funds have sold about 50,000 contracts. The premium, on the other hand, went from 120 over to 190, so it compensated for $70 of that $140 decline, which is about half of it, which is impressive. And the JM Bullion, which is almost historically cheaper than APMEX, is also 180 over for the 1 ounce American Gold Eagle. So, I mean, you could tell the premiums are remaining strong. And in my opinion, that's purely just an utter lack of supply. And therefore, replacement cost is quite high. So the premiums, in my opinion, are still supportive generally from a lack of supply. We just need the market to stop bleeding lower. Looking at the chart, that top horizontal line at 1764, That was a really key level to hold. And as you could see, that first day we broke below it, hedge funds came in and sold heavy. That was the key low in that end of November that caused a nice bounce from about 1760 up to 1940. And then we retested it. As you could see, we retested it and temporarily bounced. However, when you retest it for the third time, one thing I've learned in this market, when you retest the same support level 3 times, your odds of breaking it are extremely high. And that's what happened. We broke it, and then the funds saw that as a sign to sell it even more. So we find ourselves in this bit of a chart predicament where there's literally nothing bullish about this chart. The second horizontal line is actually the midpoint from the low when gold was around $1,100 an ounce to the high when it traded just over $2,000 an ounce. The exact midpoint was around 1625. There's a trend in markets that when you get big pullbacks after a rally, it tends to pull back half of that rally before finding support. So even though there's perhaps the appearance of a lot of bearish looking items, funds know this 50% retracement well. And I think a lot of them might step in and buy. That will also correspond with funds liquidating their entire length. And in my opinion, if they get back to a neutral position after this kind of sell-off, and you pair how tight the supply actually is, I think that is a primo buying opportunity. So when you boil it down, the physical market premiums are still bullish. The hedge fund positions, again, are short-term bearish, but I do think will provide one heck of a buying opportunity, whether it be physical or the GLD ETF. The dollar index, again, is short-term bearish. In my opinion, in the long term, it'll still be supportive as the market washes out some of this overcrowded trade and gets back to the reality that we're printing too much money and the dollar is losing value. And then the charts, again, are short-term bearish, but I think could provide some excellent opportunity if we see 1625 trade on the gold price. That's all we got. If you like these kind of videos, please subscribe as I put them out every single week. Thanks for watching. Take care.